Hello and welcome back to the Meaningful Dividends podcast for another market update. A fun one today. We're both coming from a different location. I'm in Colorado, so the picture behind me is just a background, but it's a shot of my in-laws' ranch. And I'm sitting on the porch, and so as the sun comes up this side of my face, they get a little bleached out. Dean, how you doing this morning?
I'm doing great. I've got a background as well. That's in case people haven't seen the outside of our office in Tacoma. That's I thought I'd share a picture of that.
There you go.
That's
There you go.
Kimball Creek Partners, downtown Tacoma.
Absolutely. Well, hey, we have a lot to kick off this week. It was looking back, it looks like a flat month, but that kind of masks a bigger underlying rotation.
We have had a lot going on in the markets. Yeah.
Yeah, absolutely.
Well, I think it's important just to talk about, year to date, which is probably what most people care about. Markets have been good, right? This is a good first half of the year. And we had a choppy kind of July, and S&P was down slightly, but that probably masked some pretty significant moves as things rotated around. And so, I think we can jump into that if you want to talk about what's going on and just what's happening.
Yeah, so when you talk about that rotation, the S&P being slightly down. So what we saw this last month was really a historic unwind in what we'd call the momentum trade. And so the S&P 500, which is really the benchmark that most people look at when they think about the markets, is at its core a momentum strategy. And so being a market cap weighted index, the bigger a company gets, the more of it you buy. So even if you're just a buy and hold investor, the index itself will begin to buy more of the companies that are bigger. So as a company grows, you buy more of it. It's a strategy that's been working very well for people for a very long time, but it's somewhat counterintuitive to I think what a lot of investors would think about when they think about investing. They think of this idea of buy low, sell high, and that you should be buying the things that are low and then selling them when they're higher. But and momentum fundamentally is a buy high, sell higher type of idea of you're buying things as they go up with the hope that they'll continue to move up. And again, that's worked well for quite a long time. But what we saw this last month was an unwinding of this momentum trade in kind of a big way. And I'm gonna pull up a little bit of data here that's just showing what this looks like. So what this chart is it's looking at the US Momentum Long Index monthly returns since 2000. And so what you'll see is that you have big green bars on the top, followed by big red bars on the bottom. There's a lot of volatility that comes when you're trying to do a momentum type strategy, and we're a big believer in momentum. But what stands out from this month, so here, this last July was the third worst month in the last 26 years, and it was worse in kind of a unique way. So if you look at kind of the biggest down bars on here, there's only three that approach that down 20% line. And one of them's in 2000, one of them's in 2008, both big crashes, and then one of them was this last month here in July, down 19.6%. Now, what's interesting about that is that it was a big down month without without a broader market sell-off. So 2000, 2008 were big market sell-offs. We didn't see a sell-off in that same way, but what we did see was this big down. Now that's not terrible, right?
Yeah, I think it's important when you talk about momentum because we use momentum strategies within the Kimball Creek Partners models, right? But by their very nature, what you're trying to do with a momentum strategy, you're not contrarian. So you're not buying something when it's at its absolute low and you're not selling it at its absolute high. You're letting the momentum dictate how you allocate the resources. And I think that's kind of important for people to understand because these strategies have been very good. So the fact that you had this big downturn doesn't mean that you've lost money over a 1 year period of time. What it means is you've had a very bad month. It's very sharp. And that happens in momentum. And you can see that from this chart, that it's not unusual for us to have a really sharp correction in momentum. And that's, again, because we're data driven on this, that's why we we reevaluate these. We look at this stuff on a weekly basis, on a month, bi-monthly basis, where we're being more active in some of these strategies. Why? Because we're not we're not going to catch the absolute top. We're not going to guess where that is. But as it rolls over, as momentum rolls over, then we can adjust our strategies accordingly and
Yeah,
protect.
exactly. It's one data point in a much bigger mosaic, right? And so like we look at this 1 month and it's an interesting data point for us, right? It's like, okay, it's good to see that we can have this level of variance over a 1 month period without a broader market sell-off. That's something to keep in mind. But when we just look back to, well, our momentum strategies since March, I mean, some of them were up 30 or 40%. Like this is
Yeah.
somewhat of a standardized correction,
And that's,
like and
we talk about, how the media jumps on a data point. The data point that you're going to hear in the news is momentum strategies have worse, month, third worst month in 26 years. That's the data point, and that's what
yeah.
sells ads. But the fact is, it's been a great strategy, and so relative to what it's done, it's not it's not unexpected, and it's not a shock to us, and we just follow that data.
Yeah. And for people wondering, okay, well, why did this happen? I mean, this is very much, the AI, trade. It was a lot of, artificial intelligence names, chip stocks that were, have had these massive runs and we're just coming back in line.
These are
And
the names that have carried us, have been phenomenal returns. So the fact that they had those moves, yeah, it's sharp and it's painful, but it's, you know what? Relative to what they've done, they've carried the horse, right? They've carried the ball, right? They've just been fantastic. So
yeah, absolutely. Now, this is probably a good time to bring up this other chart here. And the title of this chart, that we've given is that the markets expect giants to diverge. And this is a little bit of an interesting data point, something let's talk through like a little bit because I think it tells a good story. So what this is, this line tracks how much of the S&P's top 50 stocks are expected to move together. So the top 50 are approximately 60% of the index. So it's effectively kind of the market. And it's a forward looking read on options prices. So what's expected over the next 3 months, right? So if it's really high, they're expected to move as a group, right? They're expected to all move together. And if it's really low, we're expecting some kind of divergence. Now, when I say we and when I say expecting, what this is it's based off looking at options pricing. So where are traders in the market putting their money? What are they expecting to see happen? What are they, really like, what are the dollars telling us? Right.
if you want
And
to impress your friends at a barbecue this month, right? Because we're all out barbecuing in August, you can use the term implied correlation. You'll sound
there you
really
go.
smart,
Yeah.
right? So, where'd you learn that? Well, I'm part of Kimball Creek Partners podcast. So, implied
Yeah.
correlation, that's this concept. It's not the actual correlation, it's what the expectation is, how well these stocks are going to trade together. So,
Well, and so on a relative basis, I mean, so you look at this chart and you see like, so somewhere around a 42% is the 20, or sorry, yeah, 42, not a percent, just a 42 number is the 20-year average. And we're down in like the nines and tens right now.
yep.
Now, markets are different, things look different at different times, but just on a absolute basis, looking at that, you can say that the market is saying we expect divergence between stocks right now. We don't expect things to move in a herd. And so what that means for us, and if you look at the trades and some of the things that we're doing, we're maybe overweighting the other 450 stocks in the S&P 500 right now, taking more of an equal weight approach. We may be minimizing maybe some of those big tech names. We've had this big unwind. It's never an all or nothing kind of thing because some of those look cheap and we might be buying some of those, but we aren't just saying that we're just going to buy the index and we're going to run with the index because the market is telling us that they expect divergence here in the near future and we want to play those odds.
Yeah, these are the kind of markets that tend to favor stock selection, and so it's we've made some adjustments, and we made some adjustments last month. I think, in fairness, this isn't something this is a continuation of a theme to some of the things we did last month, and that actually worked well for us as we reduced our exposure to some of our momentum, not all of it, but some of our momentum trades a month ago. And now we're just kind of following the data, following that trend, and we're by degree leaning a little bit more into this strategy.
Yeah. One thing I'll point out on this chart, because sometimes when people see charts that have gone down, this in no way is trying to call any sort of, are we getting close to a bear market, or it's not supposed to be any kind of market predictor.
I think we had a little bit of technical difficulty there. Um, we hope that our discussion about last month's volatility and some of the shifting elements of the markets and how they might impact you was useful. Before I wrap up, I do want to address one common question that we get from time to time. And to illustrate that, I want to bring up one last chart. This chart summarizes kind of where we're at for Q2 earnings relative to the expectations of analysts. Um, the last several weeks, we've seen a number of reports. In fact, 61%, a little over 61% of companies in the S&P 500 have reported their earnings, and over 86% of those earnings reports from those companies actually beat the analysts' expectations or estimates that they had out there. We get a question, and it's fairly common. I think it's a good question. Um, why doesn't the stock market move higher when we see these results come out that beat analyst expectations? And I think it's good to remind ourselves that stock prices actually anticipate what those earnings actually are. Um, if you think through what happens if you're going to buy Microsoft or Nvidia, and you think if investors think that the report is going to be good, they'll buy shares. They don't usually wait until the earnings come out. They'll buy shares in advance of that, and that effectively drives the market higher. And so when the actual numbers come out, particularly on the day of, you'll oftentimes you might see a pop or you might see a sell-off, even when the numbers look fantastic. We talked earlier in this segment of this podcast that actually year to date, even though July has been kind of rocky, year to date, we've had very positive results. And I think the fact that earnings are so positive now kind of validates investors' expectations in January through June that July's numbers were going to be good. And they are, in fact. I think the key here is that it's not just important to track what happens, but it's also very important to track what investors anticipate. And one of the best ways to do that is to use market data, because it's the great thing about a market is that as soon as somebody has an opinion and makes a commitment based on that, everybody knows because it's reflected in the price. It is one of the major reasons why we feel so strongly about having all of our data analyzed every week. We get a 59-page report. I was bringing this up. We get a very lengthy report every Monday, 59 pages of data. Most of we're happy to send it to you, but most people don't really want to see that. But we feel it's important to track all of both market data, which reflects the anticipation of investors, but also actual data, like what were the earnings numbers, what were employment numbers, where are interest rates, and we combine those two and allow ourselves to make adjustments based on the data, not just a single data point, but on the collective data points, so that we can put the odds of success hopefully in our favor and have the best possible chance on a regular basis of succeeding in your portfolio. We appreciate your trust in us and your confidence. That's it for this month's market update from all of us here at Kimball Creek Partners. We hope you have a wonderful month of August and enjoy. Hopefully it'll be nice and sunny where you're at. Not necessarily the case right now. Hopefully it's not if it's too warm, stay cool. If it's not warm enough, warm up. And we look forward to being in touch with you in the future.